Hi, everyone. This is Ep.337 with Interactive Brokers Podcast. It's my pleasure to welcome to our podcast Mark Marex from the Nasdaq. Hey, Mark, how are you?
Hey, Jeff. Doing great. How are you?
I'm doing well. I'm so happy to have you in our studio. And you just wrote a great article, and I kind of wanted to kind of dissect it and kind of go through it for our listeners. So, Mark, your analysis, it compares today's AI boom to the late 90s tech bubble. But it's showing striking differences between, profitability between the two eras. Could you elaborate on why nearly 100% of today's Nasdaq 100 companies are profitable compared to the much weaker, fundamentals during dot-com bubble?
Yeah, absolutely. So, I mean, just even before we start off, just as a bit of background, right? Like my team is responsible for covering really all the indexes that Nasdaq has out in the market across the US and the broader Americas region. And, the Nasdaq 100 as our flagship is something we cover weekly. We put out at least one note a week for our sort of weekly newsletter that really seeks to be the leading source of research and analysis for the benchmark on the street. And so whether it's covering what's going on during earnings season, recapping performance drivers, fundamentals, technicals, thematic, macro drivers, you name it, we're trying to cover it, right? And so every quarter we have an opportunity as a team to sort of sit down and look at what is the one major thematic driver contributing to the index performance and the evolution. And as won't surprise most people, right, that's been AI for a number of quarters now in a row. And this topic really, I think, picked up in intensity sort of towards the end of 3Q into 4Q this year, of people looking at a lot of the news that's been coming out, some of the deal announcements between OpenAI and others, and starting to get a little bit skeptical, right? Skeptical about how sustainable all this is, starting to poke holes in some of the business cases and valuation stories. And, we wanted to look at it in as objective of a fashion and sort of compare to this mental anchor that a lot of investors still have in the late 90s. And so if I had to summarize the difference in one word, probably, at least at the company level for the index, is maturity, right? Late 90s, there were a ton of companies, thousands of them that IPO'd on NASDAQ that were part of, if not the dot-com sort of wave itself of internet-centric companies, then, in the more traditional hardware, software space, telecom space, a lot of these companies were brand new companies in the index. And we point that out, sort of up front. And when we look at the distribution sort of companies that were profitable versus unprofitable then and now, it's really a very, very different story, right? You had over 20 companies back then, a fifth of the index, not even earning a profit in 1999 for the full year, which was, when you think about it, that was as good as it got during the tech bubble, right? That's when fundamentals were the strongest, when everyone was bullish, when all the sort of, exponential curves around adoption of the internet were sort of peaking. And it's interesting to me, looking back on it, that, strongest fundamentals at the time, 1 out of every 5 companies was still unprofitable. Today, it's one company that's on track to not turn a profit in 2025 in this index.
And that actually, it's an interesting point you make. And it actually leads me nicely into my next question because, looking at the current PE ratios, it's not bad. It's low 30s, right? Versus the low 100s during a dot-com bubble. So, what other factors do you believe are keeping these valuations, more restrained during this, current AI wave, despite, as you mentioned, the, tremendous market enthusiasm?
Yeah. So, I mean, a lot of it has been fundamental growth, right? We've seen now 10 consecutive quarters of NASDAQ 100 sort of top line, right? Index weighted EPS growth at 15% or better, including earlier this year in 2Q, we were over 30% year over year EPS growth, which is just incredible, right? When you think about the fact that this is an index whose sort of aggregate market cap exceeds $30 trillion. It's got the 8 largest companies in the world, the Mag 7 plus Broadcom, which is one of the major players in this sort of AI infrastructure build out that we highlight in the piece. And it really speaks to, the difference in the fundamental nature of, if you're going to call this a bubble today, and you can in some ways, right, you can call it a bubble in certain parts of the industry, especially sort of on the private market side, and even some of the publicly traded players that are not part of the index, and maybe we'll get into that a bit later, but you can find some bubble-like behavior in this ecosystem today. I think it's not surprising that you will find that, given how exciting the technology is, given how much investor interest there is in it. But what you're starting out with is an index in the Nasdaq 100 of extremely successful, right, mature, fundamentally sound companies that are some of the most profitable companies in history, right? You're talking about companies in some cases that earn, $100 billion of net income over the course of a calendar year. And so the fact that you still see that EPS growth compounding quarter after quarter, despite all the investments that they're making into AI, and a lot of them are spending a ton of money on R&D and CapEx quarter after quarter, and ramping that up, year after year, speaks to some of the underlying dynamics that are different about this bubble in terms of just the nature of the technology itself and how that investment is translating into things like profits and cash flow growth, as well as, the very different way that the sort of leading spenders, the leading investors on it are approaching it. So that I thought was a very interesting sort of theme to try to dig into in the piece of it.
Yeah, no, and Mark, in your article, you kind of highlight I don't know, watershed moment's the right word, but kind of two main characters in these stories, right? Our current situation, the post Chat GPT market performance, which is up 115%. And it's less extreme though than if we go back in time, that post Netscape IPO where it was up 718%. So you kind of touched on a little bit, I think, where it's more mature index and everything now, but what would you say, kind of looking at the investor sophistication, versus the 90s as well, right? Like clearly people become more sophisticated and more informed throughout time and just being exposed to markets and trading.
Yeah, I think that's a very interesting point, and we even talked about this as a group, sort of while we were working on this research piece, and wondered about how we could quantify that, and we ended up not going down that route because it's sort of out of our general area of expertise. But I think you're right. I think in the late '90s, if people remember back to what it was like back then, I mean, this was people who were on a computer, right, day trading for the first time in their lives. It was the first time you really saw this type of super active, retail all in type of a trader looking to really make a quick buck, largely around that IPO scene, which was, disproportionately centered on NASDAQ in the mid and late 90s. That's where the vast majority of this activity took place. And I think, it's not a stretch to say that not just the sophistication of investors back there was lower, but the availability and accessibility of information was much lower, right? I think people were responding to news of companies listing and seeing the first day pop in the share prices and getting really excited about, how much money you could make just participating on those IPO days and shortly thereafter. And a lot of it was not based on fundamentally sound, investment theses, right? A lot of these companies were, if not pre-profit, then in some cases even pre-revenue. They were unproven business models. They were ideas that, because of the nature of the capital markets back in the late 90s, were still able to find a lot of capital, whether it was retail or whether it was institutional, to sort of bring them to market and at least get them trading and somewhat financed and funded for their business models. Very different situation today, where you have, OpenAI is the biggest sort of private player in this space that is seemingly going in that direction of an IPO, but they're not going to IPO as a company with a market value of 10 or 20 or even $50 million and trade like a penny stock, right? They're going to target an IPO valuation of around $1 trillion, and Anthropic's not far behind, several $100 billion. And it speaks to the very different nature of what it means to come to market. I think in today's investment landscape, the companies are staying private way, way longer, right? They have deeper pools of venture capital to sort of get them through those early growth stages and get them to a position where, okay, when they are ready to IPO, they actually can join the Nasdaq 100 on day one, as opposed to trading like a penny stock for months and then seeing what happens.
Yeah, and you touched about these companies with real revenue. I mean, that the Magnificent Seven, plus Broadcom, they generated about 630 billion in net income with 31% average margins. Versus if we go back in time, just 27 billion, which would be about 52 billion adjusted with 14.6% margins for those top 10 companies in 1999. So obviously this fundamental strength change between now and then. It's got to change the risk profile of today's tech leaders, correct?
Oh, undoubtedly, right? There's a number of different ways you can look at it, and the thing that I found sort of to be the most interesting and enjoyable aspect of unpacking a lot of this data, comparing the two periods, was this idea of a mirror, right? The index today sort of being a mirror image of itself in the late 90s, in the sense of, if you start to break this down in terms of like how the PEs are distributed, right? The vast majority of companies back then were sort of in a range of 60 or above in terms of PE. And that's how you get, an index weighted overall PE of 100, 150, even close to 200 on some days, sort of right around the peak of the bubble. Whereas, nowadays, like you said, trailing basis, low, maybe occasionally mid 30s is the peak we've seen in PE recent years. That, by the way, is below the peak valuations we saw sort of during the COVID mini bubble in 2021, prior to AI breaking on the scene, right? So it kind of gives you a bit of context in thinking of like, well, not only are we not anywhere near the valuation extremes of the late 90s, but we're not even exceeding what we saw in 2020 and 2021, when people got very excited about some of the growth prospects of a lot of these companies due to work from home and, entertain from home and play from home and all these things. But when you layer on, again, the 15, 20, 25, 30% growth rates in earnings that we've seen for several quarters in a row for a lot of these names, and they still are outperforming a lot of these very, very bullish estimates for growth, right? That means your forward PE is actually quite a bit below 30. It's sort of in the mid to upper 20s, depending on what day you look at this. And even when you drill into those top 10 names, right? Like Microsoft, one of the few, names that was among the biggest in the index in the late 90s, continues to be one of the biggest today, has a lot of staying power, is known for things beyond just the internet and beyond just AI, certainly. Microsoft is one of the few names that has been the biggest name consistently in the index. A lot of those other names, they were trading at above a PE of 100 back in the late 90s, whether it's Sun Microsystems, which is not really around anymore, right? Got absorbed. Cisco was at a PE of north of 150. You had Qualcomm close to 500. You had Yahoo at, off the charts, basically at like a PE of 2000. These were all names in the top 10 of the index back then. And when you look at it today, there's one name that has an extreme PE, in my opinion, and that is Tesla, which is, again, depending on the day, somewhere in the range of 200 to 300. And as sort of always for a long time now, has traded to its own tune in terms of, what do people think is going to happen with robo taxis and self-driving and all these things? And what's Elon going to say that's going to make the stock, pop or drop 10 or 20% at every, quarterly earnings report? So, setting Tesla aside, everyone else is sort of trading, even Nvidia, after the run up it's had, within what you would consider to be a much, much more reasonable range of, let's say, 30 to 40 in terms of, a trailing or a forward PE, where given that underlying growth rate, right, you should be willing to pay somewhat of a valuation premium on a company like that, with the level of exposure it has to the biggest growth driver in the economy today. You should be willing to pay somewhat of a premium versus the rest of the market.
Yeah, I mean, I'm starting to feel a little nostalgic when you're breaking out Qualcomm and Yahoo. I was a floor on the trader on the floor of the Philadelphia Exchange back then, so those names were all near and dear to me. But your analysis points to actually a key difference between now and then. That like actually excess capacity is not the issue at all with this current AI cycle. It's actually the opposite. The cloud providers are, potentially struggling to meet this demand. So, how might the supply demand, dynamic affect the sustainability of the current AI investment cycle?
Yeah, I mean that is the $1 million question, right? And that's something that, at least from our standpoint on my team, is really, really hard to forecast with any level of confidence in terms of whether and when we actually hit a point in time where there starts to be some excess capacity, where there start to be chips that are not being utilized 24/7, data centers that are not 100% leased out, right? The fascinating thing to me when I read about, because I wasn't trading or sort of like actively following the market in the late 90s, but I've read a lot of these studies of, what went wrong back then. And you look at some of the stories around, companies like, forget about even MCI WorldCom for now, which was a very sort of prominent story of fraud and misleading investors, but companies like Global Crossing, right, whose sort of like only business model was, let's lay as many miles of broadband and fiber as we can all around the world and connect the entire world and to the internet, and sort of, adoption and demand for that service will follow, right? Well, what actually happened in the early 2000s when the bubble popped? There was anywhere from 95 to 97% unused excess capacity of broadband, of fiber, right? That is a massive, massive overbuild of capacity that was based on, to some extent, a misunderstanding of how quickly demand for internet services could ramp, right? Like, we didn't have things like Netflix back then. Netflix obviously uses a ton more data than, a news site with just text on it. And even news sites today have video and ads and tons of other things that just didn't exist when the internet was really being built out in terms of this infrastructure, right? So part of it was, in my view, from what I've read, a misunderstanding of how long it would take for that demand to ramp and meet all the supply that was being created. And part of it was also, there was this sort of gold rush mentality of a lot of companies in the telco space went all in on this, leverage to the hilt, acquiring, smaller players as much as they could, all thinking, as long as we provide the most of the infrastructure that can enable widespread internet adoption, will sort of, recoup a lot of the benefit from that. And so look at what's happening today. You don't have dozens of companies in the hyperscaler space sort of all competing with each other to build out all of this capex. You really have 5 companies, right, in terms of the big four, Nasdaq 100, Microsoft, Amazon, and Google, sort of the dominant cloud providers, plus Meta, which doesn't have its own sort of external facing cloud business, but is still a hyperscaler at this point, given the amount of data center capacity they're building. And then Oracle sort of in the fifth slot, not part of the index anymore, not Nasdaq listed anymore since 2013. That's it. And as you say, they are all, every single quarter, talking about how much bigger their backlog is growing, right? Their sort of contracted obligations, performance obligations, to deliver capacity to OpenAI, Anthropic, whoever else is looking to run either training or AI inference within one of the data centers that they're building and managing. So, like, it's a totally different, at least at this point, situation in terms of the supply and demand underlying dynamic. And I want to stress that it's very highly unknown still. Is there going to be some technological efficiency breakthrough in a few years, maybe, that vastly reduces the amount of compute that we will need to have to train and run these models on an ongoing basis? That is possible. No one knows the answer to that, though. No one knows when that's actually coming. So it's purely a theoretical. And in the meantime, where we are is a very, very different space than where we were in the late 90s in terms of ton of capacity being built out with the hopes of it's going to get all filled in the very short term, which never happened. It took decades for all that capacity to get filled. Not today. It is all at max capacity and can't be built fast enough.
Right, and you mentioned these major AI investors like Amazon and Microsoft and Google, Meta. I mean, they're already seeing, direct return on investment, with their infrastructure investments. Again, unlike back in the 90s. So, you touched on before, but like, you know, does that, vertical integration really change the investment thesis for these companies, for these AI companies?
I mean, to me personally, that is the most interesting part of this entire dynamic in this debate. And it's one that is frankly not spoken about and debated enough, I think,
Mhm.
in the public arena, at least from what I've seen, right? Which is this notion of, again, if you're a telco company in the late 90s and you're spending a ton of money on this physical infrastructure, this capex to get the internet fully built out and delivered across the US and across the world, what is your personal, your individual benefit as a business, as a telco company, once that gets built out, right? Like in theory, sure, you're able to use the internet a little bit more, and maybe you can do things a little bit more efficiently in terms of running your own business. But it's not, in my view, it's not changing the nature of your business model. It is maybe tweaking things a little bit on the edges, but in terms of the ROI on that, the vast majority of the ROI is taking place outside the telco companies that are making these investments. If you look at all of the major hyperscalers, whether it's Amazon, Microsoft, Google, Meta, they've all been laying people off the last few years. They've all done multiple rounds of layoffs, not because their businesses are struggling. Their businesses are growing at a record pace, whether it's, Amazon retail or the core search business at Google or, the Office 365 suite at Microsoft with Copilot now being added onto it, Meta family of apps. Like when you look at the underlying metrics of the strength of their business, subscribers, time spent, engagement, all these different things, they are firing on all cylinders. And what they're telling us every quarter is they are finding ways, and in many ways, they are the leaders globally in finding ways to deploy and get internal ROI on artificial intelligence technology, whether it's Amazon launching a shopping assistant called Rufus and saying they've already seen this year 10 billion incremental revenue growth just attributed to that one enhancement, not to mention they're using, sort of their own AI model to optimize the flow of robots across their warehouses and reducing, at least 10% travel time, which is a huge number when you think about the scale of Amazon, right? It's the biggest retailer. That's just one example with Amazon, right? Like Google has talked about this with their ads business, Meta as well, in terms of using AI to get better at predicting what different types of users on their platform are going to respond to in terms of the ads that they see, what their click-through rates, what their purchase rates are going to be. And so like they're telling you there is an ROI on AI already. We're leading the way in terms of top line growth and in terms of bottom line growth and being able to get more efficient and cut costs where they see the ability to do so. And so to me, it's a really powerful argument for the theme overall, to know that the biggest spenders, the biggest investors on the technology that are sort of driving it forward are demonstrating, right, that there is a lot of value to this. And in a way, they are helping pay for and fund a lot of this investment because they're becoming more profitable in the meantime, right? That's a very, very different dynamic from, I would say, what you saw in the late 90s with a lot of the companies in the telco space that got in trouble over investing and sort of doing it for a very one-dimensional reason, which was we want in on this gold rush and we think, you know, we're going to make a lot of money because there's going to be a lot of demand in the future. It's a very, very different story in my view.
Yeah, I mean, and that goes, we already mentioned that there's this, significantly lower leverage among today's tech giants, compared to the 90s telecom companies. So, how important is this balance sheet strength in determining, if we were going to be in a bubble, but also what leverage levels would concern you if it starts to creep up? At what point is there a concern that we might, you know,
I mean, it's tough to say. I mean, I will sort of cheat a little bit on this and say if the big four approach levels that Oracle is at,
Mhm.
and again emphasizing that Oracle's not part of the index, they're at a debt to cash ratio of about 8 to 1 today, right? 8 times as much debt as they have as on their balance sheet versus their cash levels. All the rest of the other four have net negative debt ratios, debt positions. They have more cash on their balance sheet than they have debt today. And as a percentage of market cap, it ranges from about 1 to 2% for each of the four, right? Percent of market cap that's actually debt, 1 to 2%. So when you look at how much leverage some really large companies in the US are able to carry on their balance sheet and still be investment grade and still be profitable, I'm thinking of, like the AT&Ts and the Verizons of the world. There is a ton of excess leverage capacity that all these companies have. And to an extent, you've seen them start to tap that in recent quarters in terms of issuing, bonds and doing some bank loans, and also, taking advantage of some private capital and trying to finance some things off balance sheet and making guarantees there, and basically just using an all of the above approach, right? Figuring out, hey, we don't actually need to pay for all of this with internally generated cash, given how cheap it is for them to borrow, given how small of a piece of the market cap that they're actually looking to finance versus how much they're worth today. So totally different story. I think, yeah, once you get to Oracle levels
Mhm.
for the others in the big four, maybe a bit of a cause for concern at that point. Yeah.
Yeah, and then looking, at, let's say, like NVIDIA and Broadcom specifically, your article notes that they have margins, roughly 3 times higher than Cisco did during the dot-com era. What structural advantages do these, semiconductor companies have that just weren't present for the network equipment makers, in the late 90s, like that has such advantage right now?
Yeah, I mean those are the two big names, and in particular, right, a lot of people have tried to analogize NVIDIA as being the Cisco of today. And again, it's sort of like when you look at the numbers, when you stare at them, you know, whether it's
Mhm.
valuation ratios or profitability ratios, you see very quickly that they're in very different spheres. I would say, Cisco wasn't a fundamentally poor company from a fundamental standpoint. It was profitable. It had fantastic growth rates, but a lot of their growth, it was tied to companies that were building out this infrastructure, right? The physical infrastructure for the internet, and making that fundamental miscalculation of, well, we see the demand catching up to all this excess supply that we're building. So, from a very sort of high level standpoint around business case, very different situation for Cisco and its peers back in the late 90s versus NVIDIA and Broadcom today. The other major difference, though, being is that NVIDIA, right, at least in terms of GPUs, no one has been able to catch them from a technological perspective. What they're doing from a technological perspective in terms of designing chips and also supporting them with things like CUDA, which is their proprietary sort of coding platform that all the developers have been working on to build on top of GPUs for 2 decades now, right? That is an ecosystem and a level of technological advancement that is way harder, I think, in my opinion and many others' opinion, to try to catch up to and replicate if you're AMD or a Chinese semiconductor company or whatever, versus a lot of the sort of like switchgear type stuff that Cisco and others were doing in the late 90s was just not as technologically advanced, let's say. It's much harder to design and produce a leading edge GPU chip than it is to create something like that. Oh, and by the way, they have the perfect outsourced partner in TSMC in terms of their lead of, for decades now, perfecting, right, becoming the go-to source of actually manufacturing via foundry the chips that these companies are designing. So they're very sort of R&D heavy in terms of expenditure, given the cost and effort it takes to design all these chips. But they have an advantage, I would say, in the sense that a lot of that manufacturing cost, that capex cost, is outsourced to TSMC, and because of their position, they found a way to maintain those really incredible margins, right? 70% or higher gross margins, because they are, so far ahead of the rest of the pack, and they focus on the high value add work of design as opposed to manufacturing.
And one thing you hear in the news, and your article mentions this as well, that the skepticism around so-called circular financing and investment deals that are involving, right, OpenAI and NVIDIA. Could you expand for our listeners, like what these potential concerns are, and like whether they really represent a potential warning signs for the broader AI ecosystem?
Yeah, I mean that is the thing I think that started to get people nervous in the last 3 months or so. And you've seen a few of these sort of mini pullbacks in the market. I would say, the most recent one in that started in early November, mid-November, was closely tied to this news of Google Gemini, right? Sort of leaping up the leaderboards in terms of model performance, leaping ahead of ChatGPT, which of course is OpenAI's product, right? And so
Mhm.
what you have is, OpenAI obviously is in many ways like the locus of a lot of this circular deal activity, and it's unique in history in the sense of its scale is so massive as a private company. They don't quite have the same levers to pull, right, in terms of raising money as, a really big public established company like Nvidia or Google have. And so they're in a tricky situation, right? Because for, the last 3 years, right, they've been the leader in this space in terms of adoption. Broadly speaking, for consumers, you can argue, maybe Claude Anthropic's model is better adoption wise for enterprise use cases, but in many ways, right, ChatGPT is the flagship product of this AI wave. And so what they are trying to do is stay ahead technologically of Google, among others, as a private company, knowing that they need a ton more compute in terms of being able to train the models, but maybe even more importantly, deliver the models to end users in a way where, there's low latency. You're not waiting a long time for an answer to be given to you. And that answer is still somewhat high quality. And so they've been trying to solve this really complex equation for most of this year. Meanwhile, Google has limitless resources, pretty much, right? As one of the top 3 or 4 biggest companies in the world. They have Google Cloud, which is one of the top 3 cloud platforms in the world. They have, many of the leading AI researchers. So from a model sort of design research standpoint, as well as training and ongoing compute and inference, Google's got the whole package at this point. They were a little bit slow out the gate, but it's very clear that now they're sort of in a leadership position. And so OpenAI, I think, is feeling a lot of the pressure, and you will see as these models continue to jockey with each other every couple of weeks or every couple of months, when the new versions get released, you'll see this tension of sort of, well, will OpenAI be able to get back to a steady leadership position and keep the foot on the pedal in terms of their expansion, or will they have to start relying on more of these sort of, call it circular, whatever, creative financing deals,
Mhm.
where obviously if NVIDIA takes a stake and they give them a bunch of money to help them, keep iterating and keep expanding, it's beneficial to NVIDIA at the end of the day, because that means they're going to have more demand for chips as the models get more sophisticated and more data centers get built out. So I think that the way to distill it down is there's a lot of sort of cold economic logic as to why OpenAI is making these deals for their own survival and their own benefit, as well as why names like NVIDIA want OpenAI to survive and keep competing with the likes of Google and Meta in the long term. We'll just have to see how it plays out. I don't know. I don't know how much room there is globally for, 5 versus 10 versus maybe 1 or 2 sort of leading models to be the ones that everyone uses at the end of the day, right? There was a ton of search engines out there, and Google sort of won that race at the end of the day, even though they weren't the first. They weren't, as big as Yahoo and others in the late 90s, but they ultimately
Right.
won out with the best technology, the best distribution.
So, Mark, in the interest of time, I'm going to skip questions 10 and 11, if that's right, and go right to 12,
Sure.
where we'll edit that part, what I'm just saying, talking about. But so, if you had to identify one metric or indicator that investors should watch closely to gauge whether the AI boom is becoming unsustainable, what would it be and why?
That's a great question. I've thought about that question a lot in recent weeks, and I think it may surprise folks to hear that maybe PE ratio is not the best one for this cycle, right? Given just the amount of fundamental strength that you keep seeing in a lot of these leading companies, these leading AI investors, because they have so many different business models. I mean, you think about Google, right? It's not just search and the advertising business, it's YouTube, it's Waymo, it's, Google devices, like all sorts of things layered on top of it. You may not see the warning signs from a valuation perspective for the Nasdaq 100, at least the way that you did in the late 90s. I think instead you have to look at other things like, implied valuations of the big private company players in this, in OpenAI and Anthropic and others like them. If they start seeing down rounds, I would say that's a major warning signal. That's a flag to pay attention to, is the private markets activity, as well as if you see the pace of data center construction, announced investment and planned construction start to slow down. If you see that year over year growth rate in the US, for now it's still ramping up, but if it starts to peter out and plateau a little bit, that's going to impact names like Nvidia, right? Because that just simply means their forward growth rate in selling things like GPUs is not going to sustain itself at the massively high levels that it's been in the last few years. And so that might be a period of, indigestion, so to speak, for the market, when the Nvidia and Broadcoms, and to a lesser extent AMDs of the world, maybe have to adjust to, for whatever reason, financing, adoption growth, or whatever, may have to adjust to, okay, maybe there's fewer chips we're going to sell than we thought we were going to when we projected last year. But that doesn't mean necessarily, right, that the Googles, the Metas, the Microsofts, the Amazons of the world, who are spending a lot of the money on the CapEx to build the data centers, are going to suffer, right? Because all of a sudden that means maybe there is enough capacity for them to take the gas off the pedal a bit. They don't have to spend quite as much on CapEx. That's eventually going to be supportive of earnings. And maybe, the ROI question on AI will start to get more reasonable, and people will get more comfortable with, the level of spend versus the level of benefit that different players in the ecosystem are getting. So that's what I'm going to be looking out for in the next year or so. And hard to say, obviously, when that moment happens. It probably will happen at some point in the next few years. But for now, from our standpoint, it's a very, very fundamentally solid thematic investment strategy that we're tracking day in and day out and trying to stay ahead of.
Mark, this has been great. And for our listeners, you can find more from Mark Marex, the head of index research of Americas for Nasdaq, on nasdaq.com. You can also go on our website, interactivebrokers.com, go under education to find more great articles and podcasts. Once again, thank you for stopping by the studio, Mark. Really appreciate it.
Thank you so much for having me. It was a pleasure.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references